Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Riiv to receive the top 10 stocks to buy right now. Welcome, everybody. Big earnings day today. I asked a couple of my good friends who are also crazy about the market and in a lot of these companies, Jason Hall from The Smattering to join me, and Jon Quast from Working Capital JQ. How are you guys doing?
Hey, Travis. Good, doing good.
I'm excited to be on it, John. It's been a long time since you and I did anything together, so I'm really excited about it right now.
Yeah.
Well, we're going to kick it off here with Microsoft, and I think this is one of the really interesting companies in tech right now. There's a lot of turmoil in technology, a lot of the SaaS businesses that have dropped 80, 90%. And then you have these giants like Microsoft who seem like they can do no wrong. And I was listening to the conference call last night, and I just couldn't get out of my head that this is a company that's so well positioned for the next 5 to 10 years. So let's dig into these numbers. I'm gonna lead the discussion here, and you guys can jump in with anything that you have to say. I'm gonna start here with the income statement. And on the surface, some of these items don't look great. Product revenue was down from almost $21 billion a year ago to $16 billion. But that was actually because of a decline in sales for some of their tablets and then also gaming devices. So I don't think that's a huge surprise. What is really impressive is the company's services and other revenue. So this includes Microsoft 365, all their cloud services like Azure, AI things that they're starting to do now. And there's so much momentum behind this entire business that it seems like it's just building. So even as companies are starting to pull back on maybe what they're spending on software as a service, this is actually a company that may be capturing customers. And management talked about this yesterday, because as a company goes and says, oh, man, we want to cut our software spend 20%. What are we going to do? Well, you make a list of all the software you have and you go, Microsoft has a calendar tool and a project management tool. Maybe it's not as good as this bespoke product that we've been paying for, but it's cheaper and it's included. And we have all the management systems behind it already in our IT infrastructure. So that's kind of the theme here that I'm looking at. Earnings were down a little bit from a year ago, $2.50 to $2.20 last quarter. The balance sheet, again, rock solid, $99.5 billion in cash and equivalents. And then when we go down here to liabilities and stockholders' equity, again, they've got some debt, but they've been paying that down a little bit. So nothing really to be worried about from an income statement. And then the statement of cash flow. So this tells us where all this cash is going. Microsoft is on kind of a 6-month lag from the calendar year. So this is the first 6 months of their fiscal year. Cash generated in the first part of the year was $34 billion, and they used a huge chunk of that to buy back stock and pay dividends. So this is definitely a company that's growing, at least in its core services, but it's also returning a ton of cash to shareholders, which I always like to see. There are 3 business segments that we can break Microsoft down into: productivity and business processes. This is where things are really growing. This is like the Microsoft 365 suite of products. So maybe not an exciting business, but very critical business. I think of this as the kind of product that if this went down, the entire world's business infrastructure would go down. I may be overstating it a little bit there, but I think it is very critical. Business tools, revenue up 14%, just steady as you go. Look at the commercial seat growth of 16% for Office 365. Microsoft 365 customers up to I'm on the wrong side here. Up to 63.2 million people, 12% growth is what it was in the quarter. So really solid numbers there. What's more exciting for investors is this cloud segment, the intelligent cloud, as they're talking about it. This includes a bunch of businesses, so it isn't quite comparable to Amazon's AWS, but that's probably the best comparison. So again, year over year revenue up 20%, 26% on a constant currency basis, just steady as you go. And we can talk about some of the detailed numbers in here, but Microsoft Azure is growing. I think the number was 31% in the quarter. And then here was the negative in the results: personal computing. So this is the primarily hardware products. that Microsoft is making has been down over the last few quarters, up actually sequentially just slightly. This is going to be a weak segment in the market as we come out of the pandemic. People are buying fewer computers, fewer gaming devices. That's just generally going to be a little bit of a drag for Microsoft. I think the way to think about this company, and when I think about them strategically, is they've really gotten out of the business of being tied to hardware in the way that they were for the first 30 years of their history. They had the Wintel kind of behemoth in PCs where they made the operating system and a lot of the productivity tools. Intel made the chips, and then there was a whole bunch of other commodity players selling devices and manufacturing computers. They really moved to a more cloud-based software model where they don't care if you're accessing Microsoft 365 on a Mac, on an iPhone, on a PC, what kind of device you're on, as long as you're using their services. Same thing with Teams. And I think that's going to be really interesting as they grow into artificial intelligence, because they're not only providing artificial intelligence tools within some of these software suites, they're going to be the cloud service provider for OpenAI specifically, and I think potentially other AI companies, given the back end that they're building. And so now you're going to have other companies building on top of this AI focused cloud. So that's probably the next leg of growth for them. And I see so much momentum behind the business now, and I just don't see it stopping with some of these macro trends. I'll start with you, Jon. Anything you wanted to add here as you kind of look through the numbers and think about where Microsoft is sitting today?
To your point, it's a very good thing that they have moved away from just being an exclusive hardware business because, well, not exclusive hardware business, but being so tied to the hardware side of things, because I can't imagine what this business would be worth without all of its software services and cloud offerings. Yeah. And I can't imagine how much the stock would be down today if it was primarily hardware, because as you look, Windows devices, sales down 39% year over year. You look at Xbox hardware, down 13% year over year. It's not surprising. You see this in other PC companies. The demand is way down right now in personal computers. And Xbox didn't have an update recently. So you would expect that kind of thing. But yeah, cloud really coming in here as the big hero. One of the things I'll point out here is remaining performance obligations. So a lot of this is tied to Microsoft Azure. So coming in right now,
future revenue tied to long-term contracts when it delivers the services, right?
Absolutely. Yeah. Thanks, Jason. Remaining performance obligations, $189 billion, up 29% year over year. Here's what's interesting about this to me. You look at what is expected to be recognized in the next 12 months, 45% of that.
Yeah.
The rest of it beyond 12 months, and that portion of the RPO was up 32% year over year. So the stuff that is being put under contract beyond 12 months is actually growing faster than the stuff that is right now. So as you think about that, that really points to companies saying, yeah, we still are going to spend here with Azure, maybe pushing some of those obligations out a little bit further. I think that's going to be a trend generally that we see with enterprise software in the coming year.
Jason, you have thoughts?
Yeah, just a couple things to add. I think in general, like my view of Microsoft is that the business in aggregate has always been higher quality than the individual products. And you talked about that a little bit, right? Absolutely. The bundles that create so much value and make it so sticky and hard for companies to leave Microsoft and make them more likely to come to Microsoft for other things is really powerful. So I think investors, if you're looking at other companies that have competing products that are maybe better, that doesn't necessarily mean they're going to win when they're competing against Microsoft. That's important. Thinking about the balance sheet, cash flows, again, they're down, but they're still incredibly strong. Feeding that into that massive cash that's on the balance sheet. Travis, I think the odds are still probably better than even they have to buy Activision Blizzard. We'll see if that deal completely comes apart or not. But that's
I would love it if they didn't,
cash.
though.
What's that?
I would love it if they didn't, to be fair.
Oh, and honestly, I kind of wonder if maybe management would also not love it if it didn't happen at that valuation. But the point is that if it does happen, and they have to vigorously fight it, they really do, they have an obligation to. If that happens, that's a big chunk of cash that's going to come off the balance sheet. That it's really curious what kind of returns that investment is going to generate from creating that, adding to its gaming business. So I think investors need to think about that return, because let's be honest, Microsoft has made some good acquisitions over the years. It's also made some really terrible acquisitions and overpaid. And there's a chance this is going to be another one of those. Investors need to think about that going forward. I think those are the main things I wanted to say. The last one, you mentioned share buybacks, and I took a look at the long-term chart. And here's the reality. This is share buybacks over the past 10 years. This is over the past 3 years and over the past year. Microsoft is not, the company's become on a market cap basis so gigantic. At this point, those share buybacks they're material, but they're not meaningful. I think just remember that, because a lot of them are still covering stock-based compensation, and it's a modest decrease in the actual share count in total.
Yeah, I want to point out two things. I haven't updated this, but according to Google Finance right now, the price to earnings multiple is 26 and the dividend yield is 1.2%. So from a value perspective, maybe a little bit questionable. I think this is the kind of company where if you just hold it for the next 10 or 20 years, you're probably going to do pretty well. But do you want to get it at a lower price? Yeah, maybe. The other thing is, just to give my backstory with Microsoft, this is a company that I bought maybe almost 10 years ago now, on the thesis that, oh my gosh, this stock is so cheap. I think,
man, you timed it perfectly, dude. That's
hold on. Now, I think it was trading for like 9 times earnings or something like that, and had a ton of cash on the balance sheet. But you could see the business was kind of in decline because they were still tied to the PC at that time.
Well, it was in limbo. Exactly. The business today didn't exist.
Right. I made a very good return, maybe 50%, maybe 100%, and then I sold it. And I think this is another good example, a good lesson for those of you watching. Buy in at an attractive price, and then let management, if they're good at what they do what they do over time. Microsoft has grown steadily, but if you look at their long-term chart, this isn't a company that grows at an Amazon rate from a revenue growth perspective, but they've grown a little bit from both the top and the bottom line from that period of time, and they've got a higher multiple. So that as a result, the stock has done extremely well. And if I had just held on, which I didn't, I would have had a really great investment riding the back of these strategic changes that have taken a little while to really take hold. And now the challenge for somebody like me looking at this stock is, do I want to pay a 26 price to earnings multiple for a $1.8 trillion company? How are they going to make that a value long term? I think that's a much harder task than when Satya Nadella took over, and he can make some strategic changes as the business a little bit grow, and then also ride the wave of that expanding multiple. So just something to think about from a context perspective. I think right now there are a lot of investments where you can look at it and go, wow, this is really cheap, and I could justify, if I'm wrong, that's okay, because I'm going to buy a basket of 5 or 10 of these really cheap companies, and one of them is going to be the next 10x kind of a stock. So
yeah, I like that you mentioned that. That was going to be my point. I see a much stronger case to hold Microsoft than to buy Microsoft today because of that.
Yeah, I think that's a good point. We will be back here on YouTube and Twitter live as much as we can during earnings season. Don't forget to follow John at Working Capital JQ and Jason at The Smattering on YouTube, and of course on Twitter as well. You can find me at Riiv Investing. Thanks everybody for watching, and we'll see you all here next time.